Hello everyone, my name is Hitesh and I welcome you all to TradeBrains YouTube channel. Now to this video we'll be talking about one of the most practical aspect of trading in Indian market. I'm talking about how do we go about trading options on the day of expiry. Today is the Thursday of the week and every Thursday we have weekly options expiry. So we'll be talking about in detail as to how do we go about trading options on the day of expiry. I'll be using Bank Nifty as a underlying asset and we'll understand how do we go about choosing the right strike prices which we should trade, whether we should trade out of money options, in the money options, at the money options, and what are the various risks or different facets associated with it. So let's jump right into our discussion. I'm using the web portal of Zerodha for my trading purpose. It's very simple and it's the most sought after trading portal. So I'll be explaining via that. Now the most important thing while trading an option on expiry is the layout which you want to trade with. So I normally keep three indices, major ones, that is the Sensex, Nifty 50 and Bank Nifty. You might argue that why not financial services which are being started to trade. It's a relatively new product in the derivative market, so we'll be focusing our discussion using Nifty and Bank Nifty as underlying asset. Now if we see the current price of Bank Nifty, which is around 32,730, and on the right hand side I have got a 10-minute chart for the same. And so we have to understand what exactly is the trend for the day and how is the market reacting to it. Now if the biggest news for the day has been Nifty touching 50,000 and crossing and trading well above it, so the overall sentiment is bullish. Yesterday even Joe Biden took his oath as the President of United States of America. So there's a lot of positivity and sentiment in the market. Plus the vaccination news and all the other factors are contributing to the positivity in the market. Now the important factor here to understand is this: if you're an option buyer, and this is the first rule which I follow while trading options on expiry, never trade out of money options. Even if you are going out of money options while buying, trade very almost little bit out of money, not very too deep out of money. So if you are seeing that Bank Nifty is trading around 32,700, so you need to plot all the Bank Nifty options which are close to those levels. So for starters I'll be plotting the one which is at the money, that will be Bank Nifty 32,700. So I'll be using the 21st, that is this weekly expiry, and I'll be using both call and put and see how the pricing for that is. Then I'll also be doing slightly out of money, that 32,800, again both call option and put option, and 32,900. so these are the two options on the upside of current prices, and I'll be going the two below it, that is 32,600, both call option and put option, and 32,500, again both call option and put option here. So if you look here, we have a list of about 10 options which would be of interest to us while trading right now. The reason I choose the one close to current market is that the beta of all those options is more than 0.5, 0.6, 0.7, those kind of options. So the move is in tandem with the current market move. Now the next point of contention is how do I pick the options which I should be trading right now. That is very simple. For starters, we have to understand what is the market sentiment and what are we expecting out of it. If I were to give you a brief picture, the market in general looks bullish and the strength is expected to continue. And the recent high for Bank Nifty has been, if I make this chart as a daily chart, has been close to 32,700, and we are trading near it, and almost we broke the high for a day, which means the bullishness is expected to continue. The strength in the market is expected to continue. So I'll be looking, if I have to buy maybe at the money option or slightly little bit out of money call option. I'm talking about call option because I am bullish stance on the market and I'm looking to buy strength in the market. So what are the options I have in mind right now? The first option is 32,500, that is in the money option, but the premium for that is higher. Not all of us want to expose too much money on the day expiry, so we are going for at the money and slightly out of money options. So the first option which comes to my mind is 32,700 call option, that is trading at a premium of 90. And if I were to buy it, you can see at the bottom of the screen, the premium required to, or the margin money required to trade is at the current price is 22,260, which is not very high. And if I were to make it as a cover option, that is cover option has an option to put the stop loss at the time of entering. So if I were to buy at the price of say current market price of say 90, and I already mentioned the stop loss at say 60. So if you see the difference between the two prices, 90 and 60 is 30. 30 into one tick movement is 25 rupees, that is 750 rupees risk we take with the upside potential of unlimited. When I say unlimited, It won't be going skyrocketing, but we could get the premium price to be close to 150, 160, 170 because the strength is likely to be there in the market. That's one way to do it. And if you're saying that the market should breach the highs and I can go a little out of money also, so the next option which we have in mind is say 32,800. So you just go there. You have option either to place a regular order or you have option to place the cover order. You have both the option and you can choose whatever price or whatever entry point you want. Say I want to buy it at a price of 45 and I want to keep the stop loss as say maybe 25. So and the amount of margin money required is 787. Why the margin money required in cover order is lesser than the regular order? That's because regular order takes all the margin which is required to buy the option till the price of option becomes 0. So the difference between 0 and the current price 45 is 45 units, which multiplied by 25 gives you 1125, and that is the margin required. But here it doesn't take the calculation from 0 to 45. It gives you certain leverage over the amount of margin which you should be using. That is why the difference is there in the market. So if I were to put a stop loss of 30 and I put an order in the market, buy order. So this order has gone in our order book. That is, we are putting at a buy price of 45 and the stop loss for the same is 30. That is how the position we are taking in the market. So that is the perspective from the buyer of option. Now the other thing which could be looked in the market is I could be willing to write an option in the market. Now again, the sentiment of market is very important. See, as you see on the right hand side of the screen, I got a notification for the order fill in the market, and now the position is running on the screen for me right now. So if you look at the order book, the stop loss is 30. If the price comes to 30, my position will exit it from the market, and if it goes up, I can book profit for the same. Now as I was talking about the perspective of the option seller. Now again, for option seller, the sentiment of market is very important. He has to understand whether the market is bullish or bearish. If the market is bullish, then the best thing for him would be to just write off put options. Why put option? Because the buyer of the put option feels that the market will go down, but the writer, that is, or the seller of the put option, feels that the market will go up, and he just wants to milk in the premium which he gets. So the put options which we have here on the screen right now are say 32,700 put options, 32,800 put options, 32,900 put options, and out of money put options. One important key factor for any put option writer on the day of expiry, it is advisable to write slightly out of money put option because it gives him cushion to play with the market. If he sees that the market is going against the view, he can exit from the market and not lose much. But if he goes on to sell maybe an in the money put option or maybe at the money put option, the risk for him multiplies. Although he can generate extra premium, but the risk factor is too high for that. So if you are a buyer of an option, it is advisable to go for at the money and in the money. And if you are a writer of the option, it is advisable to write out of money options, or maybe to an extent a little bit of at the money, but not exactly at the money. So those are the key ingredients which we look at by trading option. I hope this video was informative and gave you a brief idea about how do we go about trading on the day of expiry. Thank you so much for your patient hearing. I'll see you in the further videos of financial education. Thank you so much.